Straddles and strangles are two commonly used option strategies involving either buying or selling a put and a call at the same time. So how do they work and when should they be used? Here to help us answer these questions is Serge Berger from thesteadytrader.com, who's in Zurich. Serge, good to see you as always. Let's start with a simple straddle firstly. How is it constructed?
Hey Victoria, sure. I mean, this is a fairly popular strategy where essentially what you're able to do with either of these strategies is you're able to make money whether the market goes up or down. The trick, of course, is it does actually have to do one of those two things. If it just stays put, you don't make money. But if you start with a simple straddle, essentially what you would do is you'd buy a call option and a put option at the same strike, so at the same level, and also using the same expiration month of your options or expiration week. And so essentially what you would do is you're making a bet of more or less an outsized move in the market, because the market has to move more than the premium that you paid for those two options combined, right? So if you paid €1 plus €1, so €1 for the call, €1 for the put, it has to move more than that in either direction to make money. So that's a simple straddle, and the strangle is very similar, except here what you're doing is you're going to buy a call and a put also at the same expiration date, but here you're going to be buying them in different strikes. So you might buy one at the €100 strike and one at the €80 strike. And what that does, it makes it cheaper. But in either situation, what you have to have happen is a serious move in the underlying asset.
So tell us a bit more about when you would use a straddle versus when you would use a strangle.
A lot, honestly, this is the thing with options, right? A lot of times both will work. It's just basically with a straddle, as you can see from the payoff diagram, you will make money quicker. So the market doesn't have to move as much in the immediate term, whereas in the strangle it's a little cheaper, but the market does have to move a bit more. Either way, basically what you're looking for is a mispricing in options. And if you like, I can give you an example, and I think this one will resonate well with the audience. What we have here is a chart of the UK FTSE index at the top. And at the bottom, I just added a very popular implied volatility or volatility index. This one's actually in the S&P 500, so we're not exactly comparing apples to apples, but it's more or less the same thing here, as you'll see in a minute. And the point in time we're looking at here was June 2016, which you probably know was when we had the first Brexit vote, or the actual Brexit vote. And what to me was unbelievably, I just couldn't believe it, was how cheap volatility was. So everyone was kind of hoping or thinking that this Brexit vote wouldn't go through. And nonetheless, though, I thought that the market was unbelievably complacent. So to me, it was a perfect opportunity to buy very cheap calls and very cheap puts, because the implied volatility, which is a very important component of options pricing, was so cheap. And so ultimately what happened was literally, you could get into the early part of June of 2016, like the June 2nd, 3rd, 5th, 6th, something like that, and we bought an at-the-money call and at-the-money put. And then what happened is, the FTSE did actually go lower, but more importantly, the implied volatility spiked, as you can see. And so we were able to make money rather quickly by just both options prices basically getting more expensive.
So I think one thing that people find difficult to get their heads around when they're first looking to trade options is the fact that you are taking that directional play out of the equation. If you're looking to do a trade on FTSE, say, you've got an expectation that it's either going to go up or down, whereas often with options, particularly with these strategies, you're actually trading volatility. Can you explain a bit more about that?
Yeah, personally, I tend to be an options seller, which is because as an option buyer, you technically don't have a very good odds of making money. But I think the implied volatility component that you're alluding to is really one of the most important things. So as a very simple rule here, what we do here at the Steady Trader and Blue Marlin Advisors and everything is we are trying to, when we use options, when we buy options, look for basically a bargain. So I'll give you another example. Actually, right now, if you look at the S&P 500, and I'm just going to go to the present time. At the top, you have the S&P 500. At the bottom again, you still have the VIX, the implied volatility, and you can see that the options prices were unbelievably cheap as recent as like a few days ago, and with the VIX below 12 or below 12 for a minute, it was ridiculously cheap given that we're going into a lot of uncertainty. So again, it was a perfect opportunity to buy a very cheap put and a cheap call, or we could have even just bought a cheap put, but it's important not to overpay for options. I think that's a really important point. And so in that sense, you're right. You can make money with a straddle or a strangle, even if the market doesn't move a lot, but the implied volatility has to go up at the very least.
Now, there's also a difference in terms of risk when we're talking about buying and selling options. You say that you're often a seller of options, but that carries a significantly greater amount of risk. Can you talk about that?
Yeah, so I mean, if you're a buyer of an option, essentially the maximum you can lose is the premium you pay. So if you pay €1 for an option, you lose €1. As a seller of option, you're basically giving someone the right to either buy something from you or giving someone the right to sell you something. So you either way, you're the recipient of something to give it to you that you may not want, or to give away something that you may not want to give away. And so there is that risk. So what we do generally is we sell option spreads. So you buy a call and you buy a protective, and you sell a call and you buy a protective call against it to take that unlimited risk out of the equation. But the great thing about selling options is that you don't have to make a directional bet. In other words, basically, if you think about the straddle here, which is again is a good strategy in the right context, but it does imply that the market does have to move at least to some extent. Whereas if you sell an option, which is a lot of what we do, what you would do is for example, let's say here on this chart, instead of making a bet that the asset in question has to go lower, I simply like to make the bet that for example, let's say it doesn't go up here, which basically means that you would make money in 2 out of 3 scenarios. You can make money whether it goes lower, sideways, or actually you can even be completely 100% wrong and the asset can go all the way up to this point and you can still make money. So that's when you turn the entire equation around, and instead of being the casino, I just got back from Las Vegas, so instead of being the casino, you actually instead of being the gambler, you end up being the casino, becoming the bank.
Now, you've talked about the FTSE and the S&P 500. Do you find that these strategies work best on indices?
They will work on I prefer to use them on indices or things representing indices like an ETF. Just because what it allows me to do is take the idiosyncratic risk out a little bit, meaning that the risk specific to a certain security. And you will find opportunities like this, several times a year. We just had one of the best examples I can give you literally just a couple of days ago. But you will find them in anything. You will find them in currencies. You will find them in commodities, where something's mispriced, where people basically are overly complacent around the risk of an event not being a big deal.
And finally, when you're looking at trying to figure out what the fair value is in terms of volatility for, say, a product, so far you've mentioned the VIX, which has been pretty crucial, obviously, for the S&P 500, but clearly gives an indication for some of the other indices like the FTSE as well. Say if you're looking at single stock options, how do you go about calculating whether that volatility is at fair value?
So here's what I do. I'm just going to quickly bring this up. So at the bottom here, you're seeing an implied volatility chart. At the top is price of this specific security. And you can see over the past 52 weeks, the past year, the implied volatility was as low as down here, which is about 18%, and as high as about 43%. So right now, all else being equal, the implied volatility is about halfway there. So it's neither super expensive, nor is it super cheap. So I like to use a 52-week look back, whether volatility is expensive or cheap. And that goes the same in the S&P 500, and you can see the implied volatility here just a couple of days ago was very, very, very cheap, all things being equal.
All right, Serge, thank you so much.
Thank you.
That was Serge Berger from thesteadytrader.com talking us through straddles and strangles. I'm Victoria Scholar, and thank you for watching IGTV.